All right, guys, during this section, what we're going to cover is a slight variation on support and resistance and looking at trend lines. Now, the difference between a general horizontal support resistance and a trend is that a trend has a lot more discretion in it. How I draw a trend may be different to how you draw a trend. Where I decide to start my trend from will be different to yours. Whereas a low, for example, there is no doubt. It's unequivocal what the low is. It is the same price no matter who's looking at that. And so this is where the difference comes in. So what we're going to have a look at is then what you're doing in terms of use of trend lines, what you're trying to achieve by using a trend line, what the purpose of it is, what it's going to tell you about trade, and where your opportunities lie. Often, a trend can be there as a way of initiating a trade before a level has broken. So it's an early potential entry point. Because what a trend is essentially showing you is positioning. And we'll go and discuss how it does this and the different ways that you can use trend lines in interpretation of trends and understanding what you're trying to get out of it when you use a trend line to play a break, to play a continuation trade, to place a stop, what exactly you're aiming to achieve. So let's move on. What a trend line essentially does is provide you higher or lower support or resistance. We know this. It's pretty obvious. You know, a market that's trending higher, you're going to get consistent higher lows on a move up, and generally you're looking for higher highs. That's the definition of a trend. Example like this little image here, you've got consistently higher lows, you have consistently higher highs. Classic trend example. So what the trend line is doing is basically just giving you a guideline to sort of assume that the progression of movement is going to remain as it is. So essentially, what a trend line is showing you is the ability of a market to accelerate or decelerate in one direction. It's showing you, and for anybody who's done sort of maths, it's showing the acceleration of progression as opposed to the direction of progression. Now, one key feature of a trend is you need 3 touches for it to be a valid trend line. Otherwise, you are merely drawing a line between 2 points. Now, when you draw a trend line, you can draw it just between 2 points. This, a bit like a level, is where you see a high, you draw that as your level, and you then assume that to be a level on the next touch, at which point you've then got a point to make a decision out. So drawing a trend with 2 touches is an acceptable way of drawing a trend. However, you can't have conviction that this trend is going to hold, and merely the 3rd touch of that potential trend line is your decision moment. That's the point where you work out, isn't it going to work? And that all comes down to order flow. It comes down to understanding what you expect to happen when a trend is retested. So don't dismiss the idea of drawing them with 2, but 3 is needed for you to say, yep, this is a valid trend, because that shows now that, like a level being drawn on a horizontal, people are consistently reacting to this progression up or down. The other issue or difficulty of a trend is that if you use different time frames, your acceleration is going to be different. If you're using an hourly time frame, for example, you may end up with a much steeper trend than if you put that same trend on a 5-minute, because there's going to be more instances between the touches. And that can give you, over time, a slightly different point at which the trend's going to break. And so this is where that level of discretion comes in, and the understanding, like with any kind of level as well, that different time frame participants or people looking at different time frame charts are going to view this as broken or not, dependent on exactly the point at which it breaks. So it is worth, if you've got a level trend drawn, to draw it on both your hourly and perhaps a 5-minute chart. This way, you get to see the kind of range of prices at which that level can actually break. As with any kind of normal level, same principles apply. More touches, it gets weaker. So you've got a trend that's been touched 4, 5, 6, 7 times. This trend is getting weaker because essentially what it's showing you is that market can't progress further in that direction, and it's constantly coming back to this same point. So effectively, we're not able to move away. Whilst, yes, maybe you're trending down, the inability of a market to gain new initiative and drive this trend lower is an indication of weakness, not strength. And we'll talk about this in terms of positioning and positioning compression in a moment, and look at examples of this, of where the acceleration comes within a trend. So your first touch on a trend is typically the point of best reaction, and that can often be the 3rd touch. The confirmatory touch is the point where typically you're going to be looking to enter on a trend. Like with any kind of level, a trend can flip from support to resistance. The difficulty, of course, there is that you have a support or resistance point that then is progressively getting further and further away from you. So using a trend once broken, to place a stop, creates a stop that progressively moves further and further away from you with time, as opposed to being at a fixed point, as it would be with a level. So what are you trying to do with a trend? How are you trying to use it? Well, essentially, what you're trying to do is you're trying to gauge positioning. You're trying to gauge whether that positioning is actually having any success of moving. Yeah, is it actually progressing in one direction, or is it positioning that is steadily building up, but is in fact actually struggling? We're going to get onto chart patterns soon, and you can use trends to sort of exemplify this even more so with, say, a downward sloping wedge. But the idea being that if the market is steadily holding a trend on the way up, what's happening there is people are progressively getting longer and longer and longer. They're not able to buy it very far down, because to hold the trend, each support has to consistently be higher. So what this does is it accumulates positions consistently higher up the page. In doing that, as the trend breaks, this is then the point where positioning may well need to turn. And so this is part of what you're using to understand what a trend is showing you the accumulation of positions. It's showing you also whether positions are becoming compressed. And so essentially what you're looking to gain from a trend is acceleration away from it, either on a break of trend, which forces positions out, or on a continuation of trend, new initiative, faster movement. So this is essentially two ways that a trend is going to create the next level of movement, sort of your point of acceleration. Now, what essentially is happening here is buyers are consistently accumulating position. Now, they're not getting further and further on side. If you think about this from the point of view, for example, of somebody who buys on breakouts, so buys as a market moves higher, if they buy here or here or here, the market consistently, so if they're buying on the break of the previous high, the market consistently puts them under quite a lot of pressure. If you're in here, you end up going a significant distance offside before then marginally further onside. And again, same principle, distance offside before onside. And what these traders are looking for is new initiative to come in to drive this higher, to accelerate the pace of movement, so thereby creating a trend that goes from this type of angle perhaps to something more like this, as the trend then continues in a more fast-paced nature. So they're building progressively higher. This is showing you steady acceleration of this move up. So what they're essentially waiting for is new buyers to come in. You're waiting for the directionally to move away from trend. More pace, and this is going to drive you away from the trend. Now, if you're in a trade, let's say you're in from somewhere down here. If you're in, you can be looking at this, and what is very helpful with a trend, of course, is that you can trail your stop behind the trend. Wonderful. So you've now got a stop that progressively moves higher. Essentially, you are locking profit in as the market rises. So that's all good. What that also means, as we discussed with the idea of a level that is tested multiple times, stops accumulate behind the level. Same principle with a trend that is tested multiple times. If you have a stop below the trend here, as time goes by, your stop may well move up, and it's going to progressively build as the trend goes higher. Now, that's fine. If you're in from down here, wonderful. You're going to, if you get stopped out higher up, you're on a nice winner. But with each test of trend, more and more people join the progressively following stops. So as this happens, now you're getting a situation where if the trend breaks, you've got a lot of people who are going to get stopped out. And this is what then creates the counter-directional acceleration here. And so it's about thinking about what needs to happen for the trend to progress either upwards or to break down. How is it likely to do this? With the breakdown, this is going to create a move that stops people out. People getting out of trades exit faster. So therefore, you can expect a break to the downside, potentially to create a quicker move. A break up is harder to define. And this is the difficulty of a break to the upside, because whilst the trend can be used as a support to build your positions higher, it's hard to define the point where we're going to accelerate higher, because there's nothing to stop this now just putting in a larger move up, but still yet coming back towards the trend. And that becomes the difficult part. So with a trend up, what you're looking for is the distinct change in the way the market trades as we move towards the upside. So the way that it moves here and here need to be different in nature to the way that it moves here if you're going to get that acceleration and that drive towards the upside. We'll look at this and we'll bring in the first pattern trade as we move towards the end of trend lines in a moment, and bring in the understanding of looking at the difference here and what the implications of this are for a further progression of a trend type move or reversal of trend type move. That's what you're looking for in terms of reaction. You're looking to either continue holding position in line with trend until you see the acceleration higher, or you're looking to play waiting for the break of on the understanding that positioning is getting constantly accumulated higher, and as such, people are going to get forced out of trades once the market turns to the downside. So let's go and have a look at a few different examples. What we've got here, 3-touch trend line. This is one in pound against the dollar. 3-touch trend, we get the break of the trend towards the upside. So this is a classic example of a trend break. We've got the trend well established, and you can see already here that yes, you're getting lower highs, but look at the lows. We end up creating essentially a poor low here. So what this is showing is that sellers are getting compressed down. They're getting no continuation in the moves that they're on. So what they're looking for is to maintain stops below the level and waiting for a break to the downside, which they get. So now you've got a situation where many of these shorts are going to be getting paid here. This is the acceleration away from trend that they're looking for. They're looking for that sort of drive down, and that can be the point where people are going to get paid. However, we now get a clue for a trend break, because now that you've got this acceleration, we don't get continuation. So you get this drive down, bounce back up, and we get back through this support zone. And we're going to look at a similar trade to this in the euro in a little while as well. So getting back above support now shows that these sellers are now slightly under pressure. This could be a situation where they're going to continue to use the trend and continue to accumulate stops behind it. And if you've been selling from up here, moving your stop down and down and down, you're feeling pretty safe. However, you are going to be giving up more than 50% of your potential winner if you maintain your stop up there. And this is why many of the shorts will potentially get out. As such, you're not going to get too much selling on the way back. Shorts have now been paid. They've got what they're after. They're not necessarily going to sell when the market comes back. So what we then end up with is a situation that you get the trend retest after a failed continuation. But what happens there is you in fact then get 5 hours. This is a 60-minute chart. 5 hours forming a mini trend at the same point. And we're going to look at this when we look at patterns, bringing in the short-term version of this, so you can see the accuracy of the execution that you could get on this trade. But for now, we're just looking at this change and acceleration towards the upside. Remember, there are still going to be people short here, but you now have people with a reason to be long. You have people viewing this essentially as a small flag or pennant for a break towards the upside. So you now have buyers potentially coming in. Buyers are going to feel more confident because we have failed to hold lower. This support has flipped to resistance and now back to support. So as you break the trend, now you're in a situation where anybody who is still short is now going to start getting stopped out. There's no reason to still want to be short once this trend breaks. This was what was holding the market down. You get this nice quick move up, target-wise as well, and this is what is very useful about a trend break. They can provide you a little bit more clarity on target. A level break doesn't. This level breaking, how far can it go? Hard to define. You can pick levels to the downside, but it's hard to define. And we're going to get more and more into this as the course goes on as to how you do define this. But on the initial break, hard to define where this is going. Upside, however, you have 1, 2, 3 clear targets, because anybody who's still left short may well continue to put their stops behind here, and they're the stops that you can then look to try and catch out as the market continues towards the upside. So that's your acceleration on a break of trend. You're looking for pace to come in. You're looking for this nice quick move towards the upside. Now, this doesn't necessarily mean that the overall trend has changed. In this situation, I would view this as trend change, because of the fact that you've been in a reasonably sideways market. So at least short term, we are changing direction and changing back to a move to the upside within a wider range. Now, if we bring this on to an S&P example, and this is one where we are in a steadily moving higher market. And what's so important here is that just because the market breaks a trend, it doesn't necessarily mean that direction has actually changed. all it's showing you is that the pace of direction has slowed down. We're still moving higher. We're just not moving higher as quickly. So what we've got here, nice steady grinding move higher. This is kind of a channeling higher. This trade can start off as you get a break of a previous record high. And that's what's happened in this situation. We break previous record high and the market then steadily progresses towards the upside. So nice, simple trade. Anybody looking to follow this steady grind higher could have been looking at this trend. Once you've drawn 2 points just here, that then indicates the potential of support coming at that third point. So this is where you're looking at this thinking, yep, get down, touch the trend again. I might have a go at buying this. As long as the market drops, slows down, you don't see that acceleration of sellers, you can look at that and think, yep, that's good, we can buy it. So you can then come in and buy it there, looking for, so you get the third touch. As long as you're not seeing any kind of change in the way the market's trading, no pace of selling coming in here, you can use this as an opportunity to buy, to continue this trend, and then follow with your stop higher. Now, the break of trend comes with a change. You get this much faster candle, you get higher volume, which we're going to come on to more and more as the week progresses. You get this much higher volume move. The nature of movement changes. Similar to the last one, you could be preempting this on a break of this mini support, break of the previous high. That may well give you your early entry opportunity. But you get this break of trend. Now, this is what's really important. The break of trend doesn't necessarily change the direction of the market. And so when you're playing a trend break like this, and I'm generally inclined more towards trying to trade a trend break because of the liquidation pace that you get, as opposed to trading a trend continuation, because the trend continuation is hard to define where the end of it is. The trend break typically is going to create acceleration. But this is what you've got to be very aware of. In what exactly are you playing for when you play the break? And this is such a question that I think everyone should always have in mind. What exactly am I trying to get out of this? If you're looking for a quick move, if you're looking for the liquidation of those long positions, you're looking fast movement straight down. That's what you're after. So if you get that, wonderful. You can start looking at these previous lows as your areas to break. And you get that. We break most of them, and this is what's crucial. We do not break all. So if you can't break all, what this is showing is that this is still a market that is progressing higher. It's just not doing it as quick now. So essentially, if you think about this as you're driving a car, you're driving along, nice steady speed, you hit some traffic, quick deceleration, you slow down. Do you stop going forward? No. It's just the pace at which you're going forward slows. And so maybe you've gone from 50 mile an hour to 20 mile an hour. You would have had this quick deceleration just here, but then continued progression up. And that's what's happening there. So you will often have a situation where on a trend break, you can end up with a trend being able to be drawn using the same initial point and then this kind of shallower trend. This is where the idea of a kind of fan concept comes from. Anybody who's read about GAN fans, things like that, this is where the idea comes from. I'm not so much of a subscriber to that because what it does imply is that you can draw these kind of very linear predictive trends as opposed to draw it on the basis of the information you have. And that's the one thing I would say here. Don't go into the realms of using something to guess where the sort of slower acceleration is going to come from. Look at it more from the point of view of take the information on as it comes. This is showing now that we're continuing higher, just at a slightly slower pace. What this will then create, or can create for you, and we'll talk about this in a moment, is a retest and use of this trend now as a resistance point. It's still a resistance that progressively is higher, and so it ends up being a point where you can actually now target towards the upside. So make sure you're thinking about what exactly the trend break means for your trade, in terms of, are you looking just for the short-term break, stop a few people out and that is all? Or are you looking for the break to initiate a much larger directional move? As such, you can then start to think about the point of asking yourself, is this just purely a deceleration of the direction, or is this an actual change? And that's the next question that you need to get to. So that brings us on to, when is a trend broken? Well, if you go with the easy answer, which is generally the kind of simple throwaway, once your time frame closes through the trend is broken. And that's always the easy answer with these kind of things. But even more so than a level, that becomes hard to define exactly at what point you have broken trend. And I'll give you an example in a moment of looking at a trend that breaks a number of ticks through, doesn't close through, but has at least a point of confluence where you can have conviction that that is far enough, that is the point where you can say, yeah, this is done. We've broken the trend and now we're going to see a change. or we've broken a trend and we're not yet at a point where any kind of change is actually coming. So you've got to ask yourself what a trend break actually means. And like I've already illustrated, is this a slowing down of the current move, or is it a full-on change of direction? Now, for a full-on change of direction, you need an additional reference point. You need a point where you can say, right, not only have we changed what's going on, we've actually now turned the market. So what I'm kind of thinking about is sort of reasons for people to believe a market is going up or down. So you get, for example, the positioning element of a trend. Let's say here, this is people getting positioned progressively long. But on top of that, you've also got to think about the participants who aren't worried about trend. They're not looking at the trend as a way of taking trades on, or using the trend as their definition of whether a market has the ability to continue or not. What they're looking at instead is the level. So now once the level's broken, the people buying because the level is broken, irrespective of trend, are now looking at this thinking, this is still okay. As long as the level doesn't break, the market is still okay to continue higher. And as such, you can end up with this situation where the market pulls back, you think, yep, trend's broken, we're going to fall. And all that happens is you get a pullback to the level and the market will then continue to move higher. So think about not just whether the direction has changed, but at what point this changes for everybody. You always kind of put the foot on the other shoe when you get into a trade and ask yourself, well, if I wanted to buy this, so let's imagine you're selling here and you're selling the trend break. If you wanted to buy it, could you still make an argument to buy? And I would suggest yes. Until you break the red level, anybody looking to buy can still look at this and say, right, as long as we're above that level, I'm still comfortable buying. And that's where you can get the reaction and then the continuation. And like I was saying before, the shallower continuation move up. This is then the point where you're expecting the real acceleration. You'll get the short-term acceleration on the trend break there. And then beyond that support level, there's now very, very little reason for anybody to still want to buy this. And that's the point where you get the additional acceleration. This is what I would call a full break of a trend. That it not only changes short-term direction, but also changes long-term perspective as well. Now, when I say short-term, long-term, that doesn't mean think of things in terms of, that always applies to a daily chart and a 5-minute chart. Think about it in terms of the move that you're currently looking at. If you're drawing a trend like this on a 5-minute chart, have you actually changed the overall picture of the day on that break, or are you changing just the progression to the upside on a 5-minute? That's the question you need to be able to answer. Okay, so let's go and have a little look at this. This is a gold one, and we're going to look at this in more detail in terms of how this could become predictable, what the hallmarks of this trade were as we get more into profile and looking at other aspects of this, delta included as well. For now, we're just going to tackle the trend part of it. And it's all about building on these pictures, building on the structure and understanding how information can help take a trade on better, to have more conviction, to have more confidence that this trend break is significant or isn't significant. So what we're looking at here then is a channel break. So this gold channeling higher. This is a 15-minute chart over the course of 3 days. So we get one move higher and then this steady progression towards the upside. So think about what's going on. Buyers have driven the market higher and are now progressively buying. So positions are getting built up here. This boxed target area is the high of the previous year, or the high of the range of, the previous month. So as long as you're above there, there's fair reason to think the market can go higher. Technically, it looks strong. The channel is then building positioning even higher than that. So there's lots of people who are now feeling that with this channel in place, they can't buy down in this area because they're not given the opportunity. So you then have a choice. Think about this if you're somebody buying for the next 2, 3, 4, 5 days. You have a choice. You can wait for it to get down into here, but you may not get that opportunity. Or you can buy it now and hope that it doesn't get back down there. And this is where people, you have to balance these thoughts out, because somebody buying it, say, within the channel and saying, right, well, I need to buy it now, they're sacrificing the potential of buying it lower down. But what they're also doing is ensuring themselves that if this does accelerate, if you get that trend acceleration up, they're going to be in on that. They're going to be part of it. And so this illustrates what the difference between an initial trend break is and then the follow-on move as the trend break is then confirmed by a direction shift. So what happens here then is you get the trend break. There's your first trend break. We've had 3 touches on the trend. So the third touch comes just before the end of the move, just in here. Then once you get that trend break, you get the acceleration down. And like I talked about with the cable example, you've got these points of reference to be looking for. You're looking for the market to accelerate through each of these lows. Now, yes, these aren't part of the trend, but they're still lows that people may be using to put, or maybe using as support. People might buy on them and buy and stop out as the market falls. So you get this quick move down. Now, at this point here, the inability to break that support zone is suggesting potentially that this has been your short-term break and we're now continuing the move higher. Yeah, this has been your traffic jam. You've stopped initially on the move higher because you've not just decelerated, you moved to a full stop, and now you're looking for a further progression towards the upside. And that is a viable scenario at this point. But what the trend break has done is it's changed the tone. And it's now opened up the possibility of a continuation move as well. And so this is what I mean by thinking about what you're trying to get when you play the break of the trend. So you play the break of the trend initially. This is a perfectly good move to go for. And that makes sense. That would be what you're looking for on a typical trend break, acceleration, liquidation type move. But once you break this low, which is also a previous support area, you can then look for the follow-on move as well, a further acceleration lower. And that's what you then get here. Because now anybody buying the trend and hoping that they've got away with it on the dip is wrong. Anybody buying the support thinking, yep, this is just a continuation of holding support that was resistance is now wrong. Everybody's essentially a seller at this point. So that's how you can use a trend to turn the overall direction. At this point here, when you get the second leg confirmation move, that's the point where I'd say the trend is absolutely broken. This isn't just merely a positioning shift. This is an overall directional change. So it's that distinction between, are you breaking the trend line or are you breaking the trend of the market? And the trend of the market is the general direction. The trend line is the specifics of this phase of movement. So this is then the further continuation of the move. So you can now start to see the entirety of this move. This was the previous range that I talked about. So resistance is broken. Resistance becomes support, even on that second confirmation. So as you get the second leg down, after the trend break, even that moves to a point where buyers may well come in once more. And so this is thinking about it from a fractal point of view. The short-term trend has changed. We move down. The long-term trend, though, if you're looking for this to be a furtherance of a move higher, hasn't. We're holding support. So this is still a collection of higher lows. And so therefore the overall trend is still intact. Once the support breaks, though, then you get the next leg down. And this then gives you the full-on turn through the range, through the bottom of the range, continuation of move. And all of that comes from that change in trend. That trend break at the top potentially leads to this. It won't always. And the point being that at each next leg down, you have to make a further decision and question, is this, again, still a turn of direction, or is this just a short-term shift back in the progression towards the upside that you are getting? By the time you break these lows here, you've taken out pretty much every support available. And at that point, you can be confident the turn has come. You can be confident the turn has come already once you get the break of support here. So as that support goes, now you can start thinking, yeah, the turn has really come. Trends don't have to be dismissed the moment they break. And acceleration to deceleration can be used to your advantage as the day progresses. This is a short-term version, and it's what I call an internal trend line. And we kind of saw that a little bit with the S&P deceleration of trend that we looked at in one of the earlier examples. Now, what we're looking at here, and it's not to say you can expect this, but you're in a market that has the ability for this to happen. This is a situation where you've got a gap higher, start the day off, and quite a clean drive towards the upside. So you then get pullback. And you get the 2 touches. This on a 5-minute is sufficient to now say, right, we've got a rather steep trend on a 5-minute chart. And this is where you wouldn't be able to draw this, because on an hourly, or you wouldn't be able to draw it on an hourly. On an hourly, all you've got here is 2 candles. So it's going to be very hard to draw a trend between 2 candlesticks. and for that trend to be meaningful. So what you're looking for then is this to be a continuation move higher. When you get a break of trend though, this is where you're looking for acceleration. So just here, you're looking for the market break trend. All of these people who jumped in, chased the market higher early in the morning, they're going to get forced out. That's your early expectation. When that doesn't happen, this gives you a pretty big clue for the day. Because what this is showing you now then is there isn't a willingness of people to sell, that these people aren't really getting driven out of the market. And so as such, you can now say, right, well, nothing's changed. And the point where things change are really going to be at this blue line down here, the most recent low. Once that breaks, then the directional trend has changed. Arguably, you could look for this area of support. You've got support here. So it's about combining your trend with levels as well. So it's bringing things together, right? Yeah, you can't trade just off one indication. So now, that reference area, the area of support or resistance that could, like we saw in gold, turn the move, give you that second leg. If that holds, you can now start to look at this and think, okay, we can continue to play this towards the upside. So you can now look to try and buy, use that support as an area to buy. You do so, you can get in down here, and you can use this to then play continuation. And the old trend, you don't need to get rid of it. And it is, to a degree, referenced here. It gets touched a couple of times just in here. The market's now using this as a pivot within the move. We talked about this with supports and resistances, that within a range, you can get these kind of pivot points where the market creates smaller ranges above and below. So with an internal trend line, now you have a situation where if you're going to buy to follow this continuation trend up, what you can do now, if you're buying this level here, the support on your second touch just down here, or you're buying on the break of the recent high, you've now got a target. And the great thing about an internal trend line target is this is an ever increasing target. So you need the market to now re-accelerate to be able to get to this level of acceleration. And in re-accelerating, you're going to get this drive up, which is going to push you further and further on side, and it needs to accelerate fast enough to be able to hit that reference point. So this then gives you a further target. Would you sell it at the internal trend? I would suggest probably not. It could be seen as a bit of resistance, but more I'd be considering this as a point to exit or take profit on a long rather than use as a short. The reason being, if the market re-accelerates, you could end up with a situation where we get back above this trend and then use it further to the upside. So it's more a point, like with those pivots in ranges that we talked about previously, to use as a target to exit position, as opposed to use as a point to, need a little cut there, Anderson. It can be used as a point to exit position, as opposed to a point to enter and try and play back down from. Bear in mind, if you're in a very clearly upward trending market, how much are you going to get out of selling this? That's what you got to think about. If you are selling it, manage your expectations. As long as it's not driving down, as long as it's a sensible point where you can play back to a support point, then you could play it. Something like this, for example, played from here, you can look back down to a recent reference and you can get a short-term move. But it's about managing expectations there and not looking for necessarily more than is available, because of the fact that you are still very clearly in an upward trending market, albeit slightly slower uptrend than it was in the early part of the day. So let's go and have a little look at a retesting trend. And there's a very similar situation here to the one that we looked at a little moment ago, the first example of the one in the pound against the dollar, this time the euro against the dollar. So we'll look to start with over here. And this is just your simple trend break. Trend break reversal, you've got the downward sloping trend, 3 touches, market finds a support, accelerates lower, fails to continue. The support becomes resistance, the resistance breaks, the trend breaks, the acceleration comes. So classic trend break acceleration move. Because what's happening here, like I said before, you get in the shorts who are short because of the trend or short trailing behind the trend. You've also got the shorts who are selling on the retest looking for that move that get trapped as well. All of these people together drive the market higher. Now, following this, we get a similar situation, but with a slightly different dynamic. Where this move is a change of trend completely. We've been in a steady downward sloping move in the euro for maybe 2-3 weeks that has moved it down 300, 350 ticks. So you get a pretty strong progression down and now turn. Whereas over here, what you're getting is a compression of positions within a wider range. Now, we know that there's a support zone formed here between this low, these lows, and then the retest. So we've got a nice clear area of support. And then moving higher, we find further support just in here, which coincides with this low. And this is then used further again. So we're building support up, but we're focusing on trend. So trend showing that people are progressively trying to sell. You're getting people positioned more short than long necessarily in this situation, or at least short and being forced to sell at lower prices. And that's the key bit here. They're being forced to sell lower prices. So market's moving down. Same as here, you're looking for a break of the lows. You get it. Break low, doesn't continue. Where does it stop? On the previous support. So previous support's been used. That's all good. So now we're back up above the old area of support. Same principle, you're looking for the trend break. So you're looking for the break and the reversal up in the same way that you get here. Bear in mind, you're not going to get as many people running for the exits on this one because this trend has been created over 4 days. Whereas this trend, whilst only created over the same number of days, is at the bottom of a much larger directional move. So you're looking for the break and the reverse. And this is where you get a retested trend and on the point of has it broken? What you can look for with a trend to define whether it's broken or not, and this is different with a level, because with a level, defining whether it's broken is difficult in that you have to sort of say, right, well, once it's through the level, you've got to apply some reasoning to say it has or it hasn't broken. And like we talked about previously, this is going to depend on time frame, it's going to depend on other levels as well. Whereas with a trend, what you can look at is clearly here from a time frame perspective and looking back, because it's always easy to look back, it never closes below trend. Now you don't know that at the time because every single one of these candles here will have been a solid red candle at some point in its creation. But with this trend break, what you've got to help you out is this support zone. And that support zone can now be your additional factor in this trend, that you're getting a retest of a trend that's broken, so therefore maintains an upward bias. And as long as you're not breaking the level and the next support, which is what we discussed with, say, gold in contrast to the S&P, in this sort of short-term example, you can now either buy the trend or use that push through to support as an opportunity to buy support, as long as the trend then closes back above. And so rather than looking at it as, has it closed below to break? Look at this as, if you can buy support and then the trend closes back above, or sorry, the time frame closes back above the trend, this is now a further reason to believe that this can go up, because people buying due to the trend are going to want to buy, people buying due to the level are going to want to buy, and that's what then allows for the market to go back up. So rather than just going on the simple, it's when the time frame closes through that the level is broken analysis, look at it from the point of view of saying, right, have you broken the level and broken a further reference? And if you haven't, you can use that as a point to then play back through. And if that support reference doesn't go and you don't get a close below the trend as well, that offers further evidence that this is a trend that's holding and then presents the opportunity of a move back up. So don't dismiss retesting trends as well, as with any kind of level, support flips to resistance. Okay, so we looked at the basic idea of a trend illustrating the overall acceleration within the market and just sort of being a way of illustrating direction to you a little bit clearer. Next up, what we're going to look at is then what the trend is doing, what it's doing for positioning. And there's two elements to this. There's compression and exhaustion. We're first going to tackle the compression side of things, because the compression is the bit that builds the energy up. You get this building up of energy for a break. So you're getting ready for the move to happen, essentially. That's what you're looking for. And this can be very short term. Things like this are, I personally think, are wonderful for playing a reversal type trade. You've had a directional move down, market gets compressed for people continuing to sell, and then you get a break of that compression, the market then accelerates back up, because that's the point that buyers can now feel confident the market has turned. So let's have a look then. This can be equally within a directionless market. And when I say a reversal, reversals often will come from a directionless market, in that in the period where the reversal pattern gets created, where the compression gets created, the market has become non-directional. So what happens is positions get squeezed and squeezed and squeezed into a smaller and smaller space. And what essentially is happening there is that sellers wanting to sell and not find buyers who are willing to pay those prices, so they move their prices down. Equally, you can end up with buyers doing the same. They can't find sellers willing to sell low enough at the price they want to buy at, so they move their bids up. and the market then becomes further and further compressed. People are now getting their fills, but they're getting their fills in a tighter and tighter and tighter range. So this effectively creates a situation where one of them is going to be wrong at some point soon. And when the trend breaks, that's the point where people get shown, now you're wrong. This is what then allows for that, that acceleration, the compression breaks out, and you get this pop of pace as people suddenly get forced out of trades. This is helpful because this can often happen in a range-bound market, and the compression that then starts to happen allows for a larger break, or it allows for you to enter ahead of the break. Because what's happening here is that the trend turns some positioning over. People get forced out. Now, the people who have positioned themselves in here at progressively lower points now may well create enough buyers to drive the market up, allied with the fact that buyers who have been still able to buy down at these prices, now seeing the market accelerate higher, may well come in to buy as well. This gives enough direction and pace to reach the top of the range. And on reaching the top of the range, now everybody short in this entire range, which is another version of a compression, is wrong. And all of those shorts now come out. All of the longs in this range also realize they're not going to be getting filled down here anymore as the market breaks out. And as such, they're going to have to come and pay higher prices. And that's what then gives you that acceleration type movement. So think about what that's doing in terms of compressing positions rather than just showing you this directional move. This is perhaps something that's slightly more short term in its nature and short term in the way that it gives you trade opportunity. So here you go. Here's an example of a market that is actually over a slightly longer period, but this is allowing you to play a longer time frame move off a very short-term positioning. So we're going to get into chart patterns as time progresses. But what you've essentially got here is a double bottom. And this is pretty textbook double bottom. But this is created over the course of 3 weeks. That's going to be a hard trade to play. So how are you trading it? Because what you could do is if you decided, right, this looks like a double bottom, I'm going to try and get in early. You could use this range to try and buy it. But this range is still 3-4 days. But what gives you an opportunity, and this is what a trend's going to help you with, is this trend that we've got here is creating this compression. This is now your opportunity to buy on the break of trend. And the idea being on the break of the trend, so in the short term, the break of the trend is going to give you enough movement to break the range. The break of the range gives you enough movement to reach the top of the wider range. So you're now using this kind of pivot within the range as your continuation point. You don't necessarily have to enter there, but you're looking at the trend to give you the early entry to break the mid-range, the pivot in the range, and reach the top of range. So what it's doing is it's allowing you to play a much larger time frame move by giving you the precision of entry, because this is now allowing you to better time not just when it's going to break. You're not looking to try and time that to predict, right, tomorrow at 10 o'clock it's going to break. But what you're trying to do is you're trying to say, right, when that breaks, I know there's now building up of positions which allows for this move, which leads to this move, which leads to this move. So you're sort of mapping out the progression of the market ahead of time. And that's what you're looking for within this. Gives you that earlier entry, gives you that opportunity to be in the move by the time you reach the point where the market could well change direction. What we've got here then is a confluence of two versions of the same thing. You've got the larger trend line, which comes all the way from over here. And it's another example, a very similar pattern that we've used already. And this again shows up in the euro. So something that you can perhaps start looking for more consistently with currencies, perhaps over something like a commodity or an equity market. But what you've got here then is a steady continuation trend down. And you've then got this much shallower trend here. And what you can see within this move immediately is a market that is not driving down in the same way as this. This move, you get a couple of phases where you get this clear drive lower. This is a point where you're getting this acceleration of movement. Sellers are taking control. They are showing initiative. And this is why the move actually gets quite a long way from the trend, from the upper trend here, because of the fact that you're getting those accelerations. This is that acceleration that you're looking for. But once this has happened and you've got this move down, then you start running out people willing to sell for obvious reason. Market has now moved down around about 200 ticks. How many more sellers are you going to find? As such, Sellers then continue to sell, creating this shallower trend. They're getting compressed. Oops. They're getting compressed now. They're selling, but they're getting nothing for it. They're getting no direction. So once these first sellers get driven out, this creates your potential turn. This is the kindling, if you will, of the fire. It's enough to get it going. It's enough to get people to think that maybe we have changed direction, because we've gone from a move that has clearly got selling strength in it, that provides these drives to the downside, followed by a move that runs out of strength, in that the sellers are very much waiting for the next leg of direction. So once this breaks, we've now got the potential of a turn. You get the retest of the compression trend as well for another potentially early entry. And then once you break the bigger trend, this is the point where people's view changes. This is the point where that drive to the upside can come, and you get the second wave move. So rather than it being through a level like we saw with the gold example, this is a second wave move through trend as well as level. So it's using two trends to kind of understand the way the market has gone from accelerating lower to compressing lower. And it's that compression lower, which is what allows that release of movement. Right, what we're going to look at then is an exhaustion type move. And how to understand exhaustion. Because what you end up with, thinking about it from the point of view of acceleration, is that once the market accelerates too fast, it's going to struggle to maintain that pace. People can't keep up with the market. People lose the willingness to continue to pay ever increasing prices. And as such, you run out of buyers. So rather than this being like a compression move where you run out of, let's say it's a compression to the upside, you run out of buyers because they kind of are realizing they're not getting paid for the move that they're looking for. In an exhaustion version, what's happening is you're running out of buyers because they're not willing to go to such prices to buy. So as you get this drive up, this essentially is a sign of desperation. It's a sign that people have kind of not lost rationality, but that they're willing to buy whatever happens. They're chasing the market. Now, whenever anyone's chasing a market, people are eventually going to run out of willingness to continue to chase. You know, you think about anything that you would want to buy. If the price goes up, you might be willing to pay a slightly higher price. But there's a limit to how much higher you pay, particularly if that price rises very, very rapidly. So what ends up happening is you get this positioning chase. People build positions very quickly higher. So market accelerates up. That's your kind of exhaustion of move. And as a result, you've now got these people who are more likely to get out quite quick. And this is the thing with an accelerated trend up. When they reverse, they can reverse quite quick, because if people have very quickly got themselves long, they're naturally in a vulnerable position. If you've chased to buy at higher and higher prices up here, you're not going to hold this very much when it comes back, because you already know that you're not in a great point. You're not in a great place, and therefore you're going to need to get out. What this then leads to is a sharp reversal, but not necessarily a turn of direction. And so that final acceleration point up is typically your point of exhaustion. The market can't continue to go at that same pace. And this then leads to the first pattern that we're going to do. So as we move into looking at chart patterns, and we move into understanding the mechanics and logic behind a chart pattern, so that's what's crucial. It's not about understanding, if this, then this, because you need to see what goes on, why these things happen. That gives you a deeper understanding of what's driving moves, who's driving the moves. So it gives you an idea of this auction theory in markets, which we're going to cover more and more detail. So what's happening then is you get this steady move higher that then becomes exaggerated. So you get this steady move here and then an exaggerated move higher. And this is what you call a bump up. Buyers chase and chase and chase. What needs to happen? Imagine that you've bought this and you've chased and you've bought here and here and here, for example. Think about where the stop is on this. People are going to be looking at that thinking the stop is a long way down. As such, they're going to adjust this. They're going to try and find a way of producing a tighter stop, maybe behind a much steeper trend, as you can see here. Now, the only way this is going to continue is if you can find enough buyers who are willing to continue buying at that pace, or you find a situation where buyers come in at some support area, maybe at this previous high, somewhere like there, create support and then go again. So sort of take a breather. Imagine you can't sprint for a long distance, but you could jog, have a bit of a sprint and then slow down before having another sprint, and this, or even before accelerating the pace of your jog again. So this is what could happen, and this is what's needed to happen for these buyers to stay in position. So during this bump phase, you get this quick build up of positions, chase higher. For this to continue, people now need to find more buyers. They need to find buyers willing to pay these prices. And typically you need a pullback before people are willing to accept higher prices than they were at. So if you get a break of this much steeper trend, this is where you get the quick reversal. People get driven back nice and quick, market drops straight back to the old trend. And that could be it. This is just a more exaggerated short-term exhaustion move back to the old trend, and that is all. But once you break the old trend, you can then end up with the run side of this trade. Because this move up, in exhausting some of the buyers, so it exhausts the buying in terms of you can't find any more buyers, but also many of these buyers here are waiting for this. They're waiting for that final drive up to exit their positions. As such, they're not going to buy when the market comes back down here. And as a result, when the trend breaks, because you've got less people who are willing to buy it, because they've now already seen the exhaustion move up and got out of positions, you now, when the break comes, have people who may well have changed their mind and are now looking to sell. You've also got the buyers who have chased up and are hoping that the trend holds, and this then leads to the run phase of the move. And so you get the quick initial reverse, and then you get the more accelerated reversal and the much more directional move that you're looking to take back the entirety of the initial trend move up. So that's the idea of using the acceleration or exhaustion move to create a pattern. And you can see the progression of what's happened within that move as to why the bump move up can create the run move to the downside. And this doesn't have to be a long-term thing. This is a very short term. This is using it on a 1 minute chart. So very, very short term, nice and simple, steady, grinding move higher. This is a 1 minute chart in the S&P over the first couple of hours of trade. You get this quick drive up, steady progression. So anybody trying to stay in this move, you're fine. You're in this sort of grinding channel move higher. It's all looking good. What you then get, and this can be helped out by breaking a level as well. So you break a resistance point, you get the acceleration up because the break of resistance brings in new buyers. It brings in buyers who have been holding along this trend, hoping for the acceleration, brings those into play. So that gives you that drive up. So now you've got the energy for the run side of things. If the bump doesn't continue, if the bump can't hold on to this recent support, or this now support, which was resistance, if it can't hold the old trend, there's your kind of bump trend, if you will, then you have the potential for a run. And this is a reasonably small move. It's not a gigantic move, but the run is there. Once you break trend and break support, you get this much steadier move towards the downside. This steady roll over down takes back the entirety of the steady grind phase of the move up. That's what you're after on a trade like this. So all about understanding the end of move, and this trend acceleration can often call the end of a move, whereas trend deceleration is perhaps more a case of slowing down something that is still going, essentially. Isn't necessarily indicative of change until you break an additional area of support, whereas the acceleration up, as long as this doesn't find more buyers at higher prices to continue, is very easily seen as potential end of movement. So I'm going to go and have a look at pattern a bit further here. And part of the understanding of pattern is to understand that patterns don't have to be absolutely precise. They don't have to follow exact rules. For example, this general trend followed by the bump phase here doesn't actually create the run on the break of the initial trend. If you're looking at this from the precision of a bump and run trade and trying to work from a sort of textbook example, you're going to look at this and say, well, that hasn't worked. And granted, in the textbook nature, it hasn't. It's become an internal trend line, and the market then later on rolls over. But the mechanics of what's happened, the importance of that exhaustion phase in ending the move up is still there. The inability of buyers to hold the old trend is still there. So what buyers have managed to do is hold a previous area of support on the initial move back down. But they've not been able to maintain the trend. So we've created now an internal trend. And this is where understanding structure and pattern, and not just simply seeing things from the black and white of it needs to do this, 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 and this, and it will do this every time precisely. It's understanding the phases of a pattern. That we've had progression, exhaustion, pullback, inability to continue higher, run, acceleration at the point where you've run out of buyers. Now here, you've not run out of buyers yet. It's just that they're not strong enough to really keep this move going. They're not showing that old level of acceleration pace. And so you don't have to be super precise on these patterns in terms of it must happen now, but it's about understanding what you're looking for when the move comes. In this run phase here, what you're looking for, because this is a move that could be viewed as completed towards the upside, in this run phase, then you're looking for accelerated move down. You're looking for sellers that come in faster and faster and faster because they're now being given the opportunity to sell. They're given that chance. They're able to now sell with conviction because they've run the buyers out. That's where the pattern comes from, or where the pattern illustrates a trade as opposed to the precision of your entry points, or your precision of the pattern working. The entry point on a trade like this is going to be here, once you break this low. Doesn't actually use this old trend. Arguably, yes, you could try and trade it, and this is the danger of selling an internal trend, that you could sell it here and here and here and here, and finally it goes. But can you sustain selling it progressively higher, hoping for this to happen? No. This could end up being just your shallow trend and continuation onwards and onwards and onwards. So you can't just continue to sell. There's no way of defining risk. Whereas once you break this low, risk can be clearly defined as here or even above that recent area of support that's now broken. And that's what's going to give you that accelerated move to the downside. It's about understanding pattern, not precision. So that's how you want to be thinking about trends. Think about trends from the point of view of what it means for positioning, how you expect that trend to break. Are you turning positioning over in the break of a trend? Are you driving positioning in that is already being built up? So you're forcing action by the market accelerating away from trend in the same direction. Because as it does that, that can be the completion of a move, because that's the movement away from trend. You're now changing the acceleration. As the market accelerates faster and faster, eventually it's going to get to a point where it cannot find enough buyers to maintain that level of acceleration. As such, it will stall, roll back, and then that opens up the counter type move. So think about it just as much from positioning as anything else, and what the trend is essentially indicating to you. Remember as well, trends aren't as precise as levels. So it may well mean that you need the help of a level to define precisely when that trend has broken. So a bit of a summary of what we've talked about in terms of support, resistance, trends, bringing the three of them together. Essentially, what you want to be thinking about with these is that any reference point that is touched, trend or support resistance, horizontal, needs to be considered as a point where a decision is going to be made. The market's going to react. Now, it can react by breaking it. It can react by using it as the intent of support or resistance and bouncing from it. Now, what you've got to do when you reach any of these points is not make assumptions what's going to happen. But you've got to say to yourself, right, I'm going to look at this point and say, right, decision is going to be made here. This is what I'm looking for. So let's say you're moving down to support, you're looking for the market to bounce away. What has to happen for the market to bounce? And you need that decided by the time you get to that point. If you're looking for the market to bounce and it doesn't show signs of a bounce, you don't have to do anything. It's not about getting to every point and saying, I'm going to make a decision when you get there, because that creates too much hesitancy and too much uncertainty of isn't it broken? You need to know what to look for. So let's say you're going to say, right, I'm going to buy this when we get there. You need to know what to look for to buy it. And that's what we're going to bring more and more in the future days. But as you're looking at this, as you're looking more at levels as you're trading at the moment, think about making your decision before you get there, and then looking at what happens characteristically when your decision works and when it doesn't. The other thing to think about is that levels are fractal, i.e. breaking a level on one time frame may not have broken the level on a larger time frame. So manage your expectations. If you break a level, and this was illustrated quite well with a trend, Have you actually changed anything, or are you just short-term changing a move? So if you've got a range of prices that somebody on, say, an hourly time frame is going to view as a range and an area that anywhere in this zone the market is still strong, then you can play from the top of that range to the bottom on a 5-minute chart, for example, but that doesn't change the overall perspective of the market. And so levels aren't necessarily broken just because you've had a short-term move or a quick move for a level. But equally, it doesn't mean you can't trade that. The distinction is you can trade that short-term move as long as you are aware and manage your expectation that that is all you're looking for, rather than assuming that a short-term move leads to a much bigger move. And finally, strength and weakness of levels. This is determined by the number of touches. So in the most basic form, the more times you hit a level, the more likely it is to break. Now, that doesn't necessarily help you, because if you hit it 5 times, it is more likely to break. But that doesn't mean if you hit it 6 that it will break. And so, like assuming or deciding that you're going to use your support to buy from, if it's been hit multiple times, you've got to say, I'm going to use that support to sell through. But still, you need to understand the order flow, what needs to happen for it to break through. So that's the first sign. And that's what's going to help you in decide what you're going to do when you get a level. Level tested multiple times, you're going to decide, right, I'm going to try and play through this level next time we get there, and then look for characteristics of a move through the level. But the nature of the way a level is hit also helps. And that's going to tell you equally about the reaction. Fast reaction, it's like hitting a brick wall. You get this really quick rip down to a level. It's like a ball hitting a wall. It will hit it and bounce away, because the sellers, let's say that you're moving down, the sellers that create the pace down are the people who are going to profit take as you hit the level, and they're going to quickly try and get out as close to the level as they can if it doesn't go straight through. Whereas a slow move and a reversal can come like something hitting a mattress and steadily bouncing. It will fall, it will have its energy sapped out. So it isn't a move that hits a support and V's up. It may well be a move that runs to a support and steadily builds on it and then reverses away. It runs the selling pressure out. And so a level doesn't have to only hold when it is approached quickly. It can be approached slowly. And as long as that slowing down doesn't then accelerate again down, we can get this move back up. The time when a level can be broken by the nature of the move to it is where it doesn't change, because a slowing down move is the same as a fast move. Essentially, at the point where it slows down, it's just a prolonged version of this. That what's happening is people who are short realize that they're not getting the break and start to buy, start to get out. People who want to buy realize that it's not breaking and start to build positions long. Same with a fast move, only this happens instantaneously. You get there and people have to make that decision. Is it going through, isn't it? And when it doesn't, because some people decide very quickly, or some people sit in there, the first people who want to take their profit provide that support, they stop the market, you run out of sellers, the market's going to bounce back quick. So when you move down quick, you get support hit. Some people who have already decided they're going to buy to take their profit provide the support. They stop, they run the sellers out. People come to sell and they find people they're willing to buy. Very quickly, other people who are short have to then start to buy. So what happens here is just a much faster version of what happens here. Now, where you don't get a change, so when the nature of movement breaks a level, is that when this move down gets to the level, it doesn't change. It doesn't slow down momentarily. It doesn't slow down instantaneously. The progression of selling keeps on coming. Steady, 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 steady. So as that happens, excuse me, that's when the level is going to break easier. So you need change. That's crucial. You need a shift in perspective as you reach a level. When you get that, that's what's going to tell you the level's about to break or not. So there we have it. That's what you need to be considering with supports and resistances. We're going to move on and look at patterns and ways to understand the mechanics of how these situations occur. So moving further down the route of understanding positioning as much as just purely price recognition and pattern recognition. So that's the next area that we'll be covering.